Hello, everyone. Welcome to another Taxes in Retirement Live. I am Andy Panko, owner of Tenon Financial. Got a great one for you tonight, a special one. I have a special guest, quick little giveaway here. I'll be talking about reverse mortgages with the one and only Josh Blum. Hello, Josh.
Andy, hello. Thanks for having me.
Thanks for being on. So Josh is a home equity retirement specialist. He's been in the retirement industry for over 15 years at this point. Right, Josh? Awesome. So we will be talking about reverse mortgage. That's when the bank borrows money from me, correct? Is that how that works? No?
When they take your house, yeah, right?
Yeah. Or is it just mortgages spelled backwards? Is that it? All right. Before we get into it, as always, let me run you all with the disclosure. So this video is only general explanations and education. It is not specific tax, legal, investment advice. Before considering acting on anything you see in this video, first consult with your tax, legal, or investment advisor, which neither Josh nor I am. We are just two blokes here talking about reverse mortgages on Facebook tonight. All right.
That's it. Exciting night.
So Josh, I hear you like jokes.
I love them.
Oh, yeah, you do. All right. Why is the mushroom always invited to parties?
Why?
Because he's a fun guy. Man, all right. Okay. This one I like. This one's relevant. My boss always laughed at my jokes at work, but since the pandemic, she never laughs at them in Zoom chats. I asked her why she doesn't laugh at them anymore. She replied, "Because your jokes aren't remotely funny."
That was bad.
That's it. Yeah. Well, I got two more here. Let's see. What's the least bad of them? So my wife said to me, "I don't really understand the science behind human cloning." I said, "That makes two of us." Because there's two of me now. All right.
All right.
You got to live through it. Sorry, you got to just deal with the pain for a little bit here, Josh. All right.
I wouldn't have it any other way, Andy. Come on.
Cool. All right. So reverse mortgages. Maybe it's anything else you want to mention about yourself again? So reverse home equity retirement specialist. Who are you? What do you do?
You hit the nail on the head. 15 years in the industry. I started out straight out of college trying to do what you did, learned real quick. It wasn't quite for me, especially at that age, and went the wholesale route where I became a product specialist in the retirement income space, 766, all the fancy licenses and everything for over a decade prior to becoming hyper specialized on what I do today, which is the reverse mortgage, or what's more formally known as the home equity conversion mortgage. I geek out in the retirement space. People listening and watching, you probably see my comments from time to time. Anytime retirement's brought up, there's a chance I might have an opinion on it. And I don't have those same licenses, so I can actually speak my opinion on it without having to worry too much. It's a nice thing. Right. Just excited to be here, man. Really excited to have the conversation and maybe open some eyes to what this is and what it isn't, and dispel some of the myths and misconceptions out there. Yeah, awesome. Looking forward to it. So maybe if we can just start. And for everyone watching at home, feel free to plop questions in. Josh is happy to answer them along the way. High level primer, super quick. I think everyone kind of knows what a basic mortgage is. You borrow using your house as collateral. What is a reverse mortgage in a nutshell? Yeah, a reverse mortgage is really by design an instrument that allows you to liquidate a part of the value of your house while you're still living in it, which you could argue is every type of loan out there. Yeah. Essentially, the primary difference with the reverse mortgage is when I borrow money and pull money from my home and from the equity in my house, I don't have to make mandatory payments on it. Okay. So it's a unique loan in that it's non-amortizing, right? There's no payment schedule. There's no fixed period of time where the balance goes to zero because I'm not mandated to make payments on a monthly basis. Add to that, Andy, that it's the only loan you can get in this country that is age discriminatory in a sense, because you have to be at least 62 and up, or if you're married, at least one out of the two has to be 62 and up. So it does have a unique space, but ultimately it's just access to the equity in your house. It's another instrument to do that. Okay. And just curious, why over 62? I mean, I know it's intended as sort of I don't know if retirement income tool is the right word, but clearly geared towards people in their 60s, obviously. But why 62? Why not 55? Why not unlimited age?
Yeah, this got passed by Congress as a bill, so this is not lender created, right? I think that's probably an important thing to recognize. That the government really came out and built this out. So it was a HUD bill passed by Congress in '87. Reagan signed it into law, I think February of '88. And by design, it's meant to help people age in place. In a lot of ways, it's very similar and analogous to Social Security, which also happens to start as early as age 62. In that it's meant to be a support system for Americans to be able to accomplish something. In this case, age in place specifically.
Yeah. And specifically using, again, the primary residence as collateral, I guess thought process is a lot of people, the equity they have built up, locked up in their home is one of the largest, if not the largest, sources of their asset, or piece of asset, if you will. So is a thought, why not use that while you're alive to pay for some of life or other things?
Yeah, essentially, you hit the nail on the head. I mean, you look at the studies, and they had studies going all the way back to 2011 on this. On average, 68% of American retirees' wealth is tied up in their house. So when we think about the average person, which I know might not be everybody listening into us in this group, for example, but it's relevant, right? There's a significantly large proportion of wealth in our homes. And for the retirement challenge we have today, which is arguably we're living a really long time, we've got to deal with longevity risk and this idea that we might outlive our money. It's a little rhetorical to ask, but it's crazy to ignore that asset, right? It should be coordinated with our planning. It should be a part of the conversation. And the reverse mortgage is not the only tool to look at when we're talking about home equity, but it's an important one.
Sure. We have a question, and maybe this may be better answered through additional sort of discussion and explanation, but Dave Fultz asks, is there an ideal age to do a reverse mortgage?
Well, it's a great question, Dave or David. There's been a lot of research done by academics on Andy's side of the desk, right? So I'm a loan officer. I work for a lender, so you got to appreciate where I'm coming from. But when you look at the academics and you look at University of Pennsylvania, Wharton School of Business, you look at Boston College, Texas Tech, you start looking at the University of Illinois, Academy of Home Equity. There's a whole lot of research out there that's been done by academics, and it's all really pointing to this same understanding. And the understanding being that the traditional place to use a reverse mortgage in most people's minds is as a loan of last resort. It's as far down the road as possible. It's let's wipe out everything else. Let's draw everything down to zero. And now we've got this as a piggy bank, if you will, at the end. It's just a place for us to keep our most important wealth and the roof over our head. That's kind of been placed on its head, right? That's been flipped. And the script really from the academics today is if you're going to need to access the wealth in your house, the sooner you can coordinate the wealth in your house with the rest of your assets, the better probability of success you're going to have. And so is there an ideal age? Now, it's going to be specific to your situation or anybody's situation where this is appropriate, but generally, the sooner, the better.
Okay. And again, 62 is the earliest you can do it, or if you're married, one of the spouses has to be 62, right?
Yeah, with the home equity conversion mortgage, Andy. So I'll clarify that a little bit. Reverse mortgage is slang. It's really any product out there that allows you to have access to the equity in your house without having a monthly payment associated with it.
Okay.
The HECM, the home equity conversion mortgage, is the FHA insured reverse mortgage. That's 94% of them.
Okay.
But the proprietary market has started to pick up significantly in the last few years. And so these are non-FHA insured reverse mortgages. And those actually can start as early as 60. We tend to see those used more on the higher affluency. So $1 million properties and above that you see that marketplace really start to build out and become more robust.
And why 60? Is that also government driven, or that's just the industry at large decided 60 is where we start this?
I think that's industry at large. Everything within the reverse mortgage world is really actuarially driven. So it's all based on life expectancy, all the calculations, everything that they're offering as a benefit and a value proposition within the tool is age-based. So the older you are, the shorter your life expectancy, the more robust benefit you're going to get. I think 60, they feel like is a good starting point.
Okay. And this may be stepping back a bit. So I was going to say, can you go more into the different types of loans? I guess there's two ways to think about it. One is the HECM, the home equity conversion mortgage, FHA insured. One is, I guess, the non-FHA insured, which you said is approximately 6% of the market. What's the difference? Why would someone choose one or the other? And then sort of next topic, if you will, is can you just go through the types of mortgages? Like, is there a fixed loan? Is there a revolver? Is there whatever?
Yeah. It's interesting. There's a lot of similarities between the two, and over the last few years, especially, they've come closer together. It used to be, and there's appreciate a lot of changes in the reverse mortgage. The HECM at large has changed significantly over the years, and it's constantly being tweaked to have a better risk profile for the FHA insurance fund, which supports it and insures a portion of this. The FHA insured HECM had a cap on home value, and that cap used to be pretty low. It's not anymore. So it's this year it's $822,000 and change. But go back a few years, it was down in the 500,000 range or below. And so when you dealt with higher value homes, it's not that you couldn't use $1.5 million home and use a HECM. It's just that all of the value you were going to derive from it hit a ceiling in regards to the home value. So it didn't matter if your house was worth $5 million or worth $1 million. You were only basing the calculations off whatever that cap was for the HECM. So the proprietary space was really designed, well, if I have a $2 or $3 or $4 million home, if I'm more in an urban area where I have really high home values, then let's create a product that still gives me some benefit for all that value of home that would otherwise get ignored by the HECM.
So is that like conventional mortgages where, traditional first mortgage, borrow to buy a house, whatever, some are guaranteed by the FHA or not FHA, Fannie Mae, Freddie Mac, Ginnie Mae, because they conform. They're called conforming loans. They're only a certain size, credit scores, whatever. And then if you need a jumbo loan, something that's larger than what the government agencies will back, then you go to a private insurer. Is this loosely similar? So they cap loan size as one of the FHA requirements?
That's a great way to kind of look at it simply. Yeah, it's very similar in that aspect to the traditional market. You've got your traditional, and then you move into the jumbo space, and this affords you the ability to do the same.
Got it. Okay. Now, what's the trade-off? So if I'm a potential reverse mortgage borrower, is it solely the value of my house and or loan size I want or need that's the determining factor? Like, what are the other gives and takes and pros and cons of going FHA insured HECM versus private?
Well, generally in the jumbo space, just like you're going to see in the conventional marketplace, you're dealing with higher rates and you're dealing with potentially less flexibility, which you especially see in the home equity conversion mortgage. So the home equity conversion mortgage, you have a tremendous amount of flexibility in the structure and what you can do with the equity you get access to. So for example, Andy, you could go ahead and you can take a lump sum up front, which there's a number of reasons you might want to do so. You could take an income stream over a period of time or over the length of time you're going to live in the house. You could create a line of credit, a non-callable guaranteed line of credit that will always be there for you down the road to use more strategically as a security blanket or a safety net, any combination thereof within the HECM. Within the structure of your jumbos, for the most part, not completely, but for the most part, they're really fixed rate loans, which means the asset needs to be used up front. Whatever equity you're taking, for the most part, needs to be used up front. Some of them do have more flexibility built in, lines of credit, the ability to draw some income, but they're very much more tightly designed. The HECM is very open and loose-ended in a lot of ways with what you can do with it. That's what makes it a really good planning tool because there's a lot of uses for it.
Okay. And fee-wise, does the FHA option come with hand in hand with either higher fees because it is insured or because of the greater flexibility versus private?
It's a fantastic question. Yes. So every reverse mortgage on the HECM side has an FHA insurance component to it. So anybody familiar with FHA loans, which traditionally we think first-time home buyers pay into the FHA mortgage insurance fund. It's the same exact fund that reverse mortgage borrowers are paying into. The difference is for a first-time home buyer, you're going to be making payments for the next 15 or 30 years, whatever the terms of your loan are. You have a monthly payment to make. Within the reverse mortgage, you're arguably never going to make a monthly payment for the most part. And so they package that up front. And that insurance is very specific, Andy. It's for the non-recourse feature of the reverse mortgage. I like to say to our everyday listeners, that's a fancy way of saying you cannot be upside down or underwater in a reverse mortgage. You're protected against that. The insurance protects you and the lender against that. The lender will always get paid whatever balance is due on the loan, whether or not you're underwater. You can never owe more than your home is worth or what it sells for at 95% of appraised value. So that insurance component, very unique to the reverse mortgage, doesn't exist in the private space. So when you go into that general marketplace, that doesn't exist. Now, as a transaction, that's 2% upfront on a home value as a transaction cost. So you think a $500,000 home, we're talking a $10,000 charge or financed expense being built into the loan that doesn't exist on the jumbo space or the proprietary space. The trade-off is I'm going to have higher interest rates, potentially significantly higher interest rates on the jumbo space. So
got it.
There's costs there. It's it's just different costs for the different tools.
Yeah. Speaking of home value, Brenda asks, how is the loan valued? Is it through an appraisal?
Yeah, it's a really good question, Brenda. Yes, every lender out there is going to require an FHA appraisal, which is a little bit different than other traditional appraisals. They look at some other items. FHA has a little bit more restrictions in regards to what is allowed on a property or not, safety purposes, so on and so forth. So an appraisal would determine the value of the house. FHA does reserve the right to require 2 appraisals and work off the lower value of the 2. On refinances, that's about 1 out of 6 homes will get a second appraisal requested.
Okay. And what's the approximate loan to value? So I'm 65. I have a home I own outright. Market value about $500,000. What's the process? What can I expect in terms of loan I may be able to get?
I think a realistic guideline to work from, because it's age-based. So my age is going to determine this, as well as the current interest rate environment. But a safe guideline is roughly 50% of the value of the home is what I'm going to have access to.
Okay.
So if it's a $500,000 home, I'm looking at roughly $250,000. That might not include whatever transaction costs are associated with that and finance into the loan. So my net might actually be lower than that.
Okay.
And if I have any liens on the house, they have to be paid off. The reverse has to be first in line. So any liens on the home, any tax liens, any existing first or second mortgages, any PACE loans, or, we see a lot of the solar roof loans on the house now that are put on as liens, all of that would have to get paid off first. And that would reduce whatever your access is going to be as we extinguish those other loans.
So that all comes out of the 250 in this example.
So if I carried $100,000 in a home equity line of credit balance, that's got to get paid off and extinguished. So my access would be 250 minus whatever my transaction costs are, minus that $100,000.
Okay. Then not that you necessarily need it, but now working backwards. So let's assume you do wipe out your other liens. The HECM is the first and sole lien at this point. Can you get another lien, a traditional home equity line of credit or something if you want to, or do those lenders not work next to a lien?
Yeah. So, that's a great question. And, you look at home equity lines of credit, HELOCs today, and a lot of lenders aren't even willing to offer them at the moment. And the ones that are really talking about coming into the space only in first in line. They won't even be willing to come second in line because there's a lot of risk associated with HELOCs for lenders.
Sure.
If you have the reverse mortgage, it is the one and only loan you will have on the house. It's the only lien that's going to be in place. The government obviously could add a tax lien on there if they needed to, and they will if you don't pay your taxes. But that opens up a whole can of worms with the reverse mortgage in the first place, because you agree to certain covenants, and paying your taxes and staying current on those is one of them.
Sure. Yeah. So I think that's important, and that may be, not to say it's a misconception, but something people may not pick up on or may not fully appreciate. So the beauty of the reverse mortgage is, like you said, you don't typically have to repay the loan or even interest while you're alive, still in the house, correct?
Yes.
But
so for
property taxes, insurance, those need to be current, right? Even things like general maintenance, like another sort of upkeep. Is that right?
Yeah. So, here I'm based in Florida, and here in Florida, we've got a lot of homeowners associations. So you agreed to really 3 primary covenants when you take out a reverse mortgage loan. you agreed to maintain the residence as your principal residence. To arguably 6 months and a day out of the year, you've got to live there. You know, is your driver's license there? Is your homestead there? That sort of thing. You agree to stay current on your taxes, insurance, and your homeowners association dues.
Okay.
And the maintenance aspect of it, you agree to keep the home in good shape. Essentially, whatever shape it was in when you refinanced or took out the reverse mortgage, you're going to keep it in the same condition. That does mean if you have HOA restrictions or rules, that you're abiding by them. If you break HOA rules, that does go against the what you're agreeing to. So that's something that a lot of people don't realize.
Now, how do people know? I mean, I guess being delinquent in property taxes and insurance fairly straightforward, but does the lender occasionally drive by your house and see if you got like a rusted out car up on blocks in the front yard or something, or how do they know the general upkeep thing?
They really don't. I mean, and even you think about how do they know you're keeping it as your principal residence? They really don't. Really, the onus on them is they're going to send out a letter once a year. They don't tell you when, that says, hey, certify that you still live here. And if it gets forwarded to another address, or it gets returned to sender, then the lender's going to do some more due diligence. But really, there's nothing out there that I haven't seen lenders come out and say you haven't maintained the house. We're going to call the reverse mortgage. It's a rule, but it's not something that they can in practice really enforce.
Sure. I guess unless you get a crazy amount of complaints from your neighbors that you got a meth lab or something going on, that wouldn't be cool. Can you talk about HECM for purchase and when that might be appropriate?
Yeah. So this is a strategy on the reverse mortgage. So I'm going to back up before I answer this, Andy. I think it's helpful to kind of talk about the three places I feel like the reverse mortgage can best be used. This is one of them.
Okay.
And then we'll kind of talk about the appropriate side of it. So a lot of where it makes sense today is understanding where retirement planning is today and where we are demographically and behaviorally in retirement. And what I mean by that is retirement today is very different from what it was in the past, and our behavior in retirement and how we manage our money in retirement is very different than it was in the past.
Yeah.
Today, and I've already talked about it, we've got longevity risk, which is something we didn't necessarily have to be concerned about in the past. We had a number of pensions in the past to really support the idea of outliving our assets. It wasn't a risk for a lot of people. Today, that's kind of flipped on its head. Social Security maybe not as sustainable as we once thought. Most people aren't carrying pensions, and the burden's on our shoulders, right? So we've got longevity risk. With that, we've got inflation, which is higher for the elderly, and housing costs especially tend to be outstripping inflation on a regular basis. So we've got increased costs going on. And we've got this scenario where people now carry debt into retirement that they never carried in the past. And it's not just credit card debt and installment debt, it is housing debt. 40% of people go into retirement with some sort of lien on their house today. That was never the case in the past. So not only do we have this scenario where it's our arguably largest asset, but we also have this scenario where retirement's different and our behavior, the type of debt we carry, has shifted. So the three places I see the reverse mortgage best to use for people: when it's a large percentage of your overall wealth, your outside wealth of the home, so your other assets, your liquid money, are heavily on the qualified side. So they're going to be taxes ordinary income. So you got some tax concerns there too, and RMDs. And then you're carrying a mortgage obligation. And about 1 out of 6 people today, I believe the number is about 18%, are going to be carrying a mortgage obligation for at least 8+ years in retirement. So that's kind of the ideal number one client that should be considering this as a tool. The second client is probably the purchase client. And the purchase is a newer concept. The purchase is using the money as a lump sum. It's this idea that just like paying off an existing mortgage, it's using it as a lump sum. This is buying a house with it in one transaction. It came out in 2011. So you think the reverse mortgage, well, Josh said it was signed into law in 88. This came out in 2011. So it's still a reverse mortgage, but it's a very different way to use it. you purchase a home, you put about 50-ish% down and you borrow the rest, just like you would with traditional financing. But the amount you borrow is in a reverse mortgage and it does not have a monthly principal and interest payment associated with it. Essentially, it does two things. It either allows somebody to really extend and leverage their purchasing power. It's almost as if you're buying cash, but now you have a lot more leverage to the cash you're putting down. Or it's kind of like buying a property on sale. Hey, you know what? I'm buying a property as if I was buying all cash, but I'm only putting about 50% down. So that, again, it becomes appropriate when you have a whole lot of equity that you would be putting into the house by not doing this, but it might not make sense to be that heavily weighted into the house as an asset. I think the easiest way for me to describe that is if I were to say, hey, you've got two places to put your money, and one place is liquid and diversified, and it's not going to be extraordinarily volatile. And, you know, generally speaking, it's not going to have these wild swings in the marketplace, and you've got access to it. So kind of all good things, a lot of flexibility there. I would argue that's kind of all the money outside of your house. When you think about the money inside the house, now I have a extraordinarily concentrated asset. It's almost like owning an individual stock in a sense. All my wealth is concentrated in one single asset that will likely and historically has had wild fluctuations in value that could change on a dime at any time. And it's a liquid for the most part. And so if that's a concern and you sit back and you say, I either can't afford the lifestyle I want, or I can't afford to really retire for any length of time, if I concentrate my wealth in a single asset like that, that's when the Heckam for purchase makes a whole lot of sense.
Okay. Got it. And does that presuppose, if you already have a primary residence, what am I trying to say? I guess you either have to sell that, monetize it to have the cash to roll into the new house, or have this other big pot of cash on the side to buy your new place with the Heckam and then sell your other one, right? Like you can't pull double duty with, or I guess maybe, can you have a Heckam on your first house and then another Heckam on your second house, or are you only allowed one Heckam per person?
Just one at a time. And it makes sense because it has to be your principal residence. You can't carry principal residence. So yeah, but you know, you think about that. There are people out there that are going to go buy a house and not sell the house that they're in. And you know, what other assets are they invading to accomplish that? You know, and well, if I'm going to buy a $500,000 house, does it make sense to draw $500,000 from the other assets if I only need to draw $250,000? And maybe it doesn't make sense. Maybe the tax ramifications don't make sense, or maybe there's a liquidity there that you can't really afford to do that, or you've got a number of reasons you might not want to do that. But for most people, Andy, the reality in this country is for most people, we're selling a principal residence. We've got a substantial amount of equity. Now it's just a question of, do we want to transfer all that equity into another home, or does it make sense to try to preserve some of that equity and keep it outside of the house if we don't need to?
Right. Got it. Okay. So that's two. And then the third time where it most makes sense?
The third time it most makes sense is when you are in a situation where you are really susceptible to financial shocks. It really becomes strategic risk management. And people have traditionally used home equity lines of credit for this, right? You know, home equity line of credit, super easy to open. It's relatively inexpensive, if not free to do. You get access to a big chunk of money in your house. You don't have to spend it until you need it. And now you have an emergency account to work with. The reverse mortgage offers you the same sort of thing, except it's not free. It costs money to do typically, and it can be a substantial amount of money, but it's non-callable, it's guaranteed, and it will always be there, assuming you live in the house and you stay current on your taxes and insurance. So from a longer term view, compare that to your home equity line of credit, which is callable by the banks. And we saw that back in 2008 to the tune of $6 billion plus of home equity lines getting called. Non-guaranteed, that has a required payment with it. And for most of us, if we're trying to borrow money for a financial shock, the last thing we want to create is a cash flow problem on the back end.
On top.
And unfortunately, that's what happens a lot of times when we use traditional lines of credit. So that third aspect is it's just pure strategic planning. It's risk mitigation and prevention for the future.
Got it. A few other questions here. So from David Myers, what are the interest rates? I guess question is on Heckams relative to traditional mortgages, which mortgage rates are really cheap right now.
They are. Borrowing money today is unbelievably cheap. blows my mind.
Yeah,
it's
right.
it's crazy. So I quoted somebody today, and let's be specific. It's May 12th, 2021, and interest rates fluctuate every day, so this is going to change. But I quoted somebody a rate of sub 2 today, less than 2% on an adjustable rate reverse mortgage. So when we compare this to traditional mortgages, I would say it's really pretty much right in line. I mean, there might be a little bit of a premium there, but it's not as if I'm paying a large premium or delta in my interest rates simply because it's a reverse mortgage. Chances are, if there is a premium, it's minor, and for the benefit of not having to make a payment, I think most people would look at it as a fairly reasonable premium. But they're pretty close in line, David.
Okay, and the so that's the ongoing rate itself. You mentioned it's a 2% upfront for the FHA insurance fund. Is there an option to spread that out? When I first learned of reverse mortgages, there's something called MIP or MPI, whatever it is. And that was basically paying a monthly fee into the FHA insurance fund. Is that not an option anymore?
So no, they've streamlined over the years the MIP, which is the mortgage insurance fund that we're talking about. So 2% upfront, 0.5% ongoing on your loan balance that's just getting financed into the loan. So we have our interest rate. Let's say we have an interest rate of 2.5%. We have what's called an effective rate. So my effective rate on the loan is not 2.5%. It's 2.5% plus 0.5% on my MIP. It's really a 3% effective rate.
And the balance of the loan, meaning only when you draw, or what you're approved to be able to draw?
Only on what you've drawn. So whatever finance closing costs you have in there, plus whatever you've chosen to spend.
Okay, got it. Another question here from the other David Foltz. In terms of the overall cost as a percentage of the value of the house, how much is it costing you for a reverse mortgage? I guess that we just sort of touched on a little bit, but
yeah, but I'll speak to it because it's interesting. Here in Florida, I think we're probably the most expensive state in the country to do it for a number of reasons. We've got some real estate transactional taxes associated with mortgage transactions. So you have a stamp tax and intangible tax. You look at the reverse mortgage and you've got a max origination charge of $6,000. So there's guidelines for what the maximum origination charges can be. And then you have your standard third-party closing costs where there's just a ton of line item third-party closing costs you're going to deal with. So you look at it and you say a $500,000 house, I have that 2% MIP. Maybe I have a $6,000 origination charge on it. I'm talking max assumed costs right now. Here in the state of Florida, you could easily have a loan of $25,000 to $30,000 of cost to get it done with maximum assumed cost.
Okay.
If I'm only getting access to $250,000 and it's costing me $25,000 as a percentage, it's a really big number. But the interesting thing about lending in the loan world is just because there's maximum assumed cost, it's not actually what you're going to pay in a competitive market environment. You know that mortgage I spoke about earlier, well, it's also got all the cost associated with it credited back. And I'm not saying that's every single case, but it doesn't matter that it's a loan that costs $30,000. The lender's paying those fees on your behalf anyways. So it's a zero cost loan to you as a borrower. I'm not saying that's always the case, but people get caught up in this idea that reverse mortgages are very expensive for what you get. It totally depends on your situation and the structure of the loan. There are a lot of levers that can be pulled there. So it's not necessarily an expensive loan. People just have this idea that they always are because your maximum assumed cost certainly can be.
Yeah. There's a few other questions, but I have some general ones. So can you walk through the different types of loans, style of loans? So there's a traditional fixed rate, and that's where, let's assume $250 is a loan amount you're able to pull. So you get that guaranteed, accessible to you. And the rate of interest is locked and guaranteed during the life?
Yeah, so let's talk about that because there's some nuances here when you look at fixed versus adjustable, which are really the two routes you can go. So fixed rate loans require you to use your money up front. So there is no line of credit associated with a fixed rate loan. So
you're pulling all $250 on day one, less whatever costs were deducted out of. Okay.
Well, there's even further nuances than that. And it's really interesting, Andy. FHA the HUD has a cap on how much you can draw on day one, and it's 60% of what that value is, unless you're extinguishing a debt obligation on the house. So unless you're eliminating a lien, you're not actually accessing $250,000. You're only allowed to access 60% of $250,000.
Okay.
So the fixed rate loans really, I think at this point, they're less than 15% of the marketplace in the reverse mortgage world because it's just very restrictive. Unless you are using it for those first two profiles I described, which were lump sum payoffs of whether purchasing a house or paying off an existing loan, the fixed doesn't make a ton of sense for people. And mathematically, it doesn't make a ton of sense because you're creating a large balance. And if you don't need a large balance, why would you create one in the first place?
Sure. Okay.
So, but fixed rate, to your point, if I'm paying a 3.5% fixed rate loan, it's 3.5% for however long I'm on the house. I could be in the house for the next 30 years. Doesn't matter. It's never moving. It's always going to be 3.5%.
And even in that case, you're still not required to pay anything other than taxes, insurance, HOA fees. You still don't have to pay anything under a fixed rate loan?
That's correct. You don't have to pay anything. You
But
could.
the
It's
interest
voluntary.
accrues, I guess. Yeah. So one extreme, you don't pay anything while you live there as your primary residence, and you keep up on taxes, insurance, HOA fees, maintenance. Whatever you don't pay, I assume the clock's still ticking on interest, so it's just adding to the outstanding loan amount, right?
Yeah. So we think a traditional mortgage, we start up here, over time we pay it off, the balance goes down, 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 down. With
Yep.
these, we start down here, and because we're choosing not to make payments more often than not, our loan balance is going up, 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 up.
Okay.
Key concept here, though, I think really, really important, Andy. We talk about the loan of last resort versus using this earlier.
Yeah.
As a loan of last resort, it doesn't matter that there's an option to make payments on it. The people doing it as a loan of last resort cannot make payments on it. They're using it for a reason. It's extraordinarily need-based. They are desperate. They are backed into a corner. I would say that's a really bad time to have to be forced to make any decision.
Right.
When we use it earlier and we use it with assets, you can make payments on a reverse mortgage. They're just not mandated.
Right.
And you now have the flexibility to treat this debt and manage it. And it becomes, the utility really skyrockets when you get to that.
So, yeah.
You probably wouldn't do that with a fixed rate loan, though. I mean, if you're going to do something like that, you would probably want to do the adjustable rate because you have a line of credit. And just like traditional lines of credit, for those of us who are familiar, if I borrow money and then pay it back, it becomes accessible again.
Yeah.
And so if I'm going to get a reverse mortgage and I'm going to make payments into it, I probably would want the adjustable rate because it gives me access to that money again.
Okay. I have a question about adjustable rate. Before that, I think this segues nicely into Mavis's question. Are there potential issues or things to look out for the heirs of someone that does reverse mortgage? So back to my previous example, you take out a fixed rate loan, 60% of 250. What is that? That's that's $150 if I did the math right. 150,000.
Pretty good.
I think so. Yeah. All right. 25 times. Yeah. So let's assume person dies, they never repaid the loan. So now that loan's 300 grand, let's say. House value's 400. What happens? Walk through at a high level. The estate administration. What do the heirs have to do? What happens with the house and the loan?
Yeah, this is where the concept of like a ladybird deed or some sort of assumability upon death, transfer upon death makes a whole lot of sense, because otherwise the house is going to probate, and depending on what probate's like in that specific state, it could become a real headache and hassle for heirs. More often than not, the challenge with somebody passing with a reverse mortgage is the heirs are not an authorized individual to the lender. So the lender is not allowed to give them any information, and it's got to work through probate. And the challenge with that is HUD mandates that lenders start foreclosure proceedings within 6 months. So if the borrower is no longer in the residence for 6 months or 12 plus months, while they're still alive, HUD's mandating that the foreclosure proceedings start. So the lenders have no choice here. They have to legally start foreclosure proceedings. And it's just a pain in the butt because you might not be able to manage to that within probate until probate gets cleared. So in that sense, it all comes down to planning. I mean, truly, a reverse mortgage to me should never be used in a vacuum. It should be part of a greater overall plan.
Yeah.
And if your estate planning is done correctly, the reverse mortgage really should be a very, very clean instrument to pass on to heirs and beneficiaries. There's either going to be value left in the home, in which case there's net proceeds to pass on to the estate if people choose to liquidate, or they can choose to refinance the loan into another loan under their names and keep the home, or pay it off with outside assets and proceeds. Or there's no equity left in the home, in which case, the estate's essentially selling it or providing a deed in lieu of foreclosure to the lender and saying, hey, there's no reason for me to deal with this. It's a dead asset to us, right? There's no value in the house anymore. It's been spent. Key piece here, the non-recourse feature, there is no additional liability being passed on to beneficiaries. So if my house is worth $500,000, but I owe $750,000, we're not passing on an additional $250,000 of liability to the estate or beneficiaries. That's being paid by the insurance fund. That's the non-recourse insurance you're paying for.
So there's no risk to the heirs there if it is underwater upon the death.
Correct.
Got it. Okay. And just, this may be more of a legal question, but you mentioned 6 months estate administration. So if I'm the child of a parent who recently died and has an outstanding reverse mortgage balance, and let's assume the house is titled to me, not titled to me, but in the will, the house is left to me, let's say. Can I, or the executor, what am I trying to say? Who actually sells the house? The bank completely controls the sale of the house to get themselves paid back and the estate gets what's left? Or can the executor and or kids control the sale?
So executor and kids control the sale. So I mean, this is their home and ownership, right? In this instance, the ownership has passed to them. They're owners. The bank is just a lien holder. And so they have control. And as long as they're showing good faith effort to satisfy the lien in some way, that 6-month window can actually be extended by 3 months, 2 times. So effectively you have a full 12 months to satisfy the lien, as long as you can show the servicing lender a good faith effort to satisfy, whether that's sale or refinance, whatever it has to be.
And in the interim, from the time the person dies to when I actually sell it 6 to 12 months later, still nothing is due other than upkeep, taxes, insurance, whatever, correct?
Yes, but your interest also happens to continue to be accruing.
Still running,
right. So I mean, that's the negative to kind of dragging your feet on it. You probably want to satisfy the obligation at that point as soon as you can to limit the growing liability, assuming there's still equity in the house.
Got it. Another quick question, and then I have a question about the mechanics of the adjustable rate style. So Tao asked, does a reverse mortgage pay for the real estate taxes and insurance? I guess similar to a traditional mortgage where it's kind of lumped in your payment. How does it work here?
It could be. That's called a life expectancy set aside. And the reason it's called a life expectancy set aside is because we don't know how long you're going to live as a borrower. And so we use an actuarial table to determine your life expectancy. And we say, if you're going to escrow or impound your taxes and insurance and pay for it out of the house, out of the equity of the house, you have to do that based off your life expectancy. So let's say it's $4,000 a year and you're going to live for the next 20 years. Well, that's $80,000 of equity that you no longer have access to. It's set aside to go pay that. And twice a year, the lender will pay it out of the equity of the house. You can be forced into this situation if you have a credit history that's not ideal and you've shown a pattern of irresponsibility or inability to pay on your debt obligations. You can be put in a position where they say, hey, if you want to do this, you have to do this set aside. Or if you don't have enough residual income, you have to show a certain level of income. You have to qualify for these, Andy. A lot of people don't realize that. It's not as if I own a house, I have equity and I'm over 62, give me a reverse mortgage. Nuh-uh. Used to be that way. Not anymore. Now it's, I've got to show financial responsibility and I have to show that I have the ability to pay taxes and insurance, not just today, but down the road. So I have to have a certain level of income, not as onerous as traditional financing, but there is still, the need to qualify. There's a financial assessment component to this. That's a big change from what it used to be.
Now, can you talk about that? I think a lot of people's opinion of reverse mortgages is seeing, I don't know, Chuck Woolery or Robert Goulet pitching it, 15 years ago, right? But don't get me wrong, I love Chuck Woolery as much as the next guy. But so what changed? You mentioned the underwriting's different. You have to qualify now. Sounds like you didn't before. So can you talk about I guess it was financial crisis was the turning point, pre-financial crisis, and now what's different? What's better, what's worse, even in the industry?
Yeah, I'll start with an analogy because chances are most of our viewers are probably sitting with a cell phone somewhere near them, and we could probably all say you might have a Samsung, I might have an Apple. A phone's a phone's a phone. And it's true, but chances are none of us are walking around with phones from 20 years ago. Nobody's got a phone that needs to get plugged into the wall that they're walking around with, right? The challenge in the reverse mortgage world is you still have plenty of people who bought a reverse mortgage 20 years ago walking around with one. And so the reverse mortgage has changed tremendously over the years, and especially after the financial crisis, because that financial assessment didn't exist. There was really no litmus test to see if you should be able to get a reverse mortgage or if you could actually afford to age in place, which is what this is all about. There needs to be some sort of test there to say, can you actually afford to live in your home? Because for a lot of people, the answer is no, and they shouldn't be using a reverse mortgage. They need to find alternatives. So we look at the reverse mortgage today, and really, really good news. The HUD and the FHA has done a tremendous job of really reducing the risk associated with a reverse mortgage, not just to the insurance fund, but to the consumer. And they put a whole lot of additional consumer safeguards in place that did not exist in the past. Really, especially around couples where you had somebody who was over 62 and somebody under 62. So you had a borrower and a non-borrower. There used to not be protections for that. So you hear horror stories in the reverse mortgage. Oh, husband passed away, wife's getting kicked out of the house. It's because the loan came due. She wasn't a borrower. Husband borrowed the money under his name and she had no rights. Well, that's the past. Just last week, and again, May 12, 2021, just last week, they came out with some new regulations that have to go in place latest September 3rd, 2021. Lenders can put them into place today. You can get married after you start a reverse mortgage and still have spousal protections in place. And the spousal protections are essentially, hey, you can stay in the home as a spouse and you can defer this maturity of the loan, the payment. You can defer that for as long as you live in the house and abide by everything else the borrower had agreed to, staying current on taxes and insurance, so on and so forth. So when you look at the financial assessment, you look at the non-borrowing spouse and the spousal protections that are in place that weren't in the past. And then you take into account that the actual benefit that you can get from this has been reduced significantly from where it was a decade ago. So the government actually said, hey, if you're saying 50% is the guideline, Josh, well, 10 years ago, it might've been 75%. The government's brought that down a number of times, which is good because people are living a long time and these should be structured where you still have equity in the home. But Andy, I got to admit, there's a long way that needs to go here. When you look at other countries, because the reverse mortgage is not unique to the States. Australia, it's really, really big in Australia. Canada has it. South Korea has it. China has it. The UK has it, along with a number of other things. The number of people in the UK using this versus the States, it's about 5 to 7 times. So why is it so much dramatically different in the UK versus the US? Well, behaviorally, people aren't any different in the UK than they are here, right? We're all the same. We all have the same challenges. So there's nothing that you can really point to that says it's behavior. It really has to come down to the structure of regulations and restrictions and how the government has, tweaked the design. It's less flexible here, and it's kind of more of a challenge, I think, than it is in other countries. As they continue to streamline this, the utility for more people is going to increase. I think right now we're at like 100,000 people on average are using this a year. It fluctuates a little bit. It's a really small piece of the pie. You look at the amount of people denied 62 and up for traditional mortgages, Andy, it was something like $400,000+ in 2018. 400,000 plus people were denied. Anywhere from, I think the number is up to 27% of those would have qualified for a reverse mortgage if they had applied for a reverse mortgage. And 5 million people over the age of 62 today carry a traditional mortgage. So we look at, there's 100,000 people that did it. I'm not saying it's appropriate for 5.5 million people, but they're somewhere in between is where that number really ought to fit if it continues to streamline the way I think we'll see it, because it's a necessary tool.
And streamline how? Streamline, you mean less options, less like what's different in the regulatory environment or the product itself between here and UK, for example?
So that's a tough question for me to answer in a short amount of time. I think what and it's not just consumer facing, it's lender facing, right? It's what's the burden on the lender? It's the idea that we have to follow all the FHA rules versus conventional rules. That alone, and you speak to anybody in the mortgage industry, the burden of an FHA financing or a VA financing, these government insured financings versus conventional financing, the burden's much higher on the entire industry. And so if you can relax some of that, and I'm not saying increase risk, I'm just saying relax some of these rules and restrictions, make it kind of more normalized towards conventional loans and financing, that would make it a lot more accessible to a lot more people. And if I were to sum that up, I would sum it up in like the condominium space. Like condominiums can have a reverse mortgage on them, but probably 99 out of 100 condominiums cannot have a reverse mortgage on them because of the rules and restrictions around FHA financing. So even though technically you're allowed to do it, and every other phone call I handle in Florida is for a condominium, chances are it's not going to happen. And that's where the accessibility is really tough here versus where it might not have that challenge in the UK.
Interesting. Not to get on too much of a sidebar, but why are condominiums problematic? Is the price deemed to be more variable than regular houses, single family houses?
You're pooling a number of people under one roof. And so you have to recognize simple rules like it has to be principal residence. Well, when we're dealing with a pool of people, at least half of that pool of people need to be principal residents. In condominiums, that's not always the case. Condominiums, you have upkeep for community grounds and community space.
Yeah.
A lot of condominiums don't keep up reserves for that. FHA requires at least 10% reserves. So down here in Florida, a lot of the condominiums, they just do special assessments. Well, great. People are fine with assessments. Hypothetically, the FHA is not, though. FHA says, no, you can't have special assessments. Show us 10% reserves. If you don't have 10% reserves, you're not financially responsible as a condominium association. Sorry, we're not going to underwrite.
Got it.
So that's the sort of thing that knocks condominiums out. And then FHA, last but not least, not to go into the weeds, but you cannot discriminate on assumability. The FHA says anybody can assume a property if you want to abide by fair housing rules and restrictions. A lot of condominiums, the association docs say we get to choose if somebody lives here or not. We don't want a felon living here, which okay, no problem. I think most people living in a condo might be okay with that. FHA is not. That's not okay. That'll knock you out. So there's a number of reasons, condos, but that's the sort of thing where it's an accessibility issue.
Right. No, that makes sense. That's interesting. I didn't think about that. So the FHA does not want you discriminating against convicted felons, it sounds like.
Against anybody.
God, the nerve.
It's not picking our felons.
All right. Yeah. I didn't read this yet, but good evening. What would be a rough estimate for the loan if the current LTV is, say, 40% instead of Andy's example of a house owned outright? Roughly 50% of the 60% equity in the house. Not sure that's going. Maybe there's a loan already outstanding.
Yeah, that's how I'm reading this. So if I have a loan that's roughly 40% of the house, so let's use really easy numbers. Let's say it's a $100,000 home. I owe $40,000.
Yep.
I can access roughly 50% of the value of the house. So I can access roughly $50,000. My access is $10,000, right? Arguably pay off the existing lien of $40,000, 40%. I have access to $10,000 or 10%. I can't tell if this is asking about the fixed rate, which it might be. I don't want to make assumptions on the question. I don't want to misanswer.
Right. Fair. A few more questions, right? So I want to know, and I don't know the answers, which is legitimately why I'm asking, but like the revolver, the fixed, the floating rate. So let's go see simple example. The loan I'm approved for is $100,000. I don't take any of it yet. I want it there for flexibility, whatever. I've read that those can actually increase over time. How does that work? So I get traditional home equity line of credit. It's a $100,000 loan. Tap it when I need it. Pay interest as loans outstanding. Pay it back whenever I want. Goes back into the pot for another $100,000 to borrow. How does it work in this scenario?
So your adjustable rate, you've got three options today. And this is a recent change just at the end of last year. But you have three options. You have an annual adjustable, which has a 2-1 adjustable, so it can adjust up to 2% a year, up once a year, with a ceiling of 5% over where you start. So if you start at 2.5%, your ceiling's 7.5%, and you can't move beyond 4.5% your first year, right?
Got it.
So that's the 2-1 adjustable with the ceiling annual. You also have monthly, and a monthly with a 5% ceiling and a monthly with a 10% ceiling.
Okay.
And with the monthlies, you don't have the limit on you don't have that 2-1 aspect. So you just have the ceiling. And so I might have a 2.5% loan where my ceiling's 7.5%, or my ceiling could actually be 12.5%.
And the loan, it's the rate itself can change monthly.
Correct.
Okay.
Exactly right. And that rate we're talking about is the constant maturity treasury, which it's the replacement for the LIBOR, the London Interbank Overnight Rate, which most institutions and instruments have been moving away from for a number of years.
And is it that, or is that plus some spread?
Yeah. So there's a margin associated, right? So your constant maturity treasury today is basis points, 0.1, and change, something along those lines. So you will have a margin on there. What the margin is kind of dependent on the market and the environment that we're in. Right now, your margins are really pretty low. I mean, if you think about it, I talked about a sub 2% loan earlier. We're dealing with very low margins in our current environment. It's a very good macro environment from an interest rate perspective.
Okay. And so I get my loan. I can choose to roll the initial cost into the loan, or I guess out of the loan, if I'd like, correct?
Yeah, more often than not, people who are doing this are not coming in to bring cash in to reduce their closing costs. They're financing almost all of them into the loan.
Okay. And so the let's say it's $20,000 total. I'm making a number up. So that the clock starts accruing on that $20,000 once the loan is live, right?
Correct.
Okay. And is that how the available draw can go up over time? Like, that's something I never fully grasped.
Yeah, it's really difficult to explain. The way these are built and structured, Andy, is the line of credit you have available. So the equity you have available that you haven't spent is in a line of credit with the adjustable rates. The structure of the loan is such that whatever interest rate is on the loan for the balance, the entire amount of access. So let's say the access is 250. The entire amount of access is going to grow by that interest rate. So your balance might be $20,000 growing at, let's say, 3%, but the entire $250,000 that you have access to, so the remaining 230 is also expanding at that same exact interest rate.
I'm not charged interest on it yet, but the amount available is increasing by
correct. So today I have $230,000 available in a line of credit, and I look at it again in a year, it's going to be 230,000 times 3%, because my access has actually grown, because that entire pool is growing by that interest rate.
Now, why do they do that? It seems dangerous for the lenders, unless they're supposing property values always go up.
It's not dangerous for the lender. It's dangerous for the FHA insurance fund, right? The lender is always going to get
insured. Yeah.
So you have the RICP designation, and Wade Pfau has a great book around this. For those viewers, Wade Pfau is a part of the American College. The American College.
Yeah.
He wrote a great book on this. He did a ton of research on using the reverse mortgage as a planning tool, and his feeling is the value proposition right now in the line of credit with the reverse mortgage is way out of bounds with the risk that's being taken on the shoulders of the FHA insurance fund. So he thinks long term we're going to see the HUD really pull back on that line of credit and how that grows and restrict it in some way. And I wouldn't be surprised, because right now it's whatever that line of credit is grows indefinitely. I mean,
okay. So that is what I thought I understood, but I was like, that doesn't seem right. That seems like such a not freebie, but so in the interest of the borrower at the detriment of the lender.
People don't use it that way, right? And that's the thing, right? I think if more people used it and took advantage of that, then the government would really kind of take a much closer look at what are we offering here. But because most people aren't using it that way, most people are not using this as a strategic tool to plan against future risk. Most people are just, I have a need, I'm going to use it.
Yeah.
And that's really where there ought to be a shift, because if you're going to use the reverse mortgage, the very needs-based use is probably the worst use. I'm not saying you have other choices at that point. It's just not ideal. If you look at how these are really built, much better to use it as a long-term strategic vehicle.
Okay. I have a question about the general underwriting and approval process before we get there. Teresa's question. So this isn't, I guess this isn't specific to the mortgage, but what happens with the home basis in the 3 situations when the owner dies? I'm going to venture to say unrelated to whether you have a mortgage outstanding or not, right? The basis is what it is. It's the house value on date of death, or 6 months later if the executor chooses the alternate valuation date for estate purposes.
Yeah, there was a great string on that, right? I think somebody asked a question, I don't know if it was about the reverse mortgage, but about mortgages in general, about being put on the deed of the house before somebody passed away. And a lot of people talked about how you would lose the step up in basis in that situation. And so I think it's really irrelevant to the mortgage, to your point, Andy.
Yeah. Okay. So yeah, Teresa, I don't know this with 100% certainty, but I would think unrelated to whether it's a mortgage or not, simply the value of the house on the date of death is the basis, and that's what gets stepped up to. If there's a mortgage against it, so be it. If there's not, doesn't matter. The basis is the basis. Question from Mavis again. Can you go over what happens if home values decrease significantly, such as 2008 housing crash, how it impacts the reverse mortgage customer? So Mavis, I'll assume you mean while the person's still alive. What happens if anything here, Josh? House drops 30%, 40%. You're in South Florida or Vegas or something.
You know, it's an interesting one, Andy. And Mavis, I appreciate the question, because a lot of people, that's their big fear. You know, I borrow money from my house and then the value of my home drops. There's a really strong argument, the same argument that's kind of made in the annuity world with income guarantees, that if I'm going to do some sort of insurance or hedge strategy, which the reverse mortgage in a lot of ways could be considered an insurance instrument, better to do it when values are high versus when values are low. I'm getting the most out of it, the most value out of it. That's where your worst case scenario with these, if you really think it through, is you spend through the value of your house. That's the worst case scenario. We're opening up a bucket of money to spend that you wouldn't ordinarily be able to open up. So you start spending it down. If the value of the house drops, it doesn't necessarily impact what you can draw. What you can draw is guaranteed, right? So what's accessible to you, you've already put in place and guaranteed, regardless of what the value of the house is. That's the nice thing about this. It can act as a hedge. Now, it acted as a much stronger hedge a decade ago before they reduced how much you could access. Now the house would have to drop really precipitously for it to be a hedge. But you know, in this instance, if you have the reverse mortgage, you have removed the equity you have access to. You have removed that correlation from the home value. It is no longer correlated to the home value. That's kind of where this becomes an insurance instrument. You divorce those two things.
So I guess Mavis answered the question, really nothing, right? So long as you can keep paying property taxes, insurance, HOA fees, stay in the house as primary residence, maintenance and upkeep, house value is irrelevant. The only one that's going to hurt is whoever your heirs are. They get less out of your estate. Is that fair assessment, Josh?
Yeah. I mean, you think about any given asset, a stock, for example, the point of purchase matters and the point of sale matters. It's really no different with this. You know, in between, it's irrelevant.
So I've been talking on the assumption, you know, you take your house to the grave, but what if you do decide to sell? So now let's go through this example. So your house was $500,000, you got a mortgage of $250,000, house dropped 60%, it's underwater. You're 80 years old, you don't want to age in that house anymore, so you go to sell. What happens? Can they dip into you for the difference, or it's still non-recourse above and beyond the value of the house, even when you're alive, and sell?
As long as you're selling for at least 95% appraised value, and that does not have to include realtor fees, right? So you can still pay a real estate agent to sell your house. You can never owe more than what the house sells for. So that 95%, that's kind of appraised value is just what you need to sell for. So in that instance, you're not the guarantor on the loan. right? That's a big difference between this and most other types of loans where you have a personal guarantee on those. You do not with the reverse mortgage. The house carries it.
And that's just HECMs, or is that the private flavor as well?
I want to say both, but don't hold me to that, Andy, because there's there's a few of them on the private side, and they could all be a little bit different. Most of them follow the HECM really closely, though. They follow almost all the same guidelines. So chances are, yes, but I'd rather not. Don't hold my feet to the fire on that one, please.
Okay, sure. All right. So, question from me about the underwriting process. So when I learned about these 4 or 5 years ago, there was a course that prospective borrowers have to go through. There's the suitability, can you afford this type thing? So can you just walk through what's involved? So you have to be 62 for a HECM. So let's assume I'm 63, my house is fully paid. I'm interested in reverse mortgage. What's the process?
Yeah. So the great question. Generally with underwriting, something unique is the counseling you just described. Every consumer doing a reverse mortgage has to go through counseling. There's government approved debt counseling services out there. It's an in-person or over the phone meeting where they review your options, they review your budget, they make sure that there's no elder abuse going on or fraud, there's no coercion, there's nobody taking advantage, and there's mental capacity. So there's a number of things that they're really checking on to make sure that people understand this is not their only option, because a lot of people have absolutely in the past been taken advantage of by people who are not ethical and they're just trying to make a sale. And it's a problem. I mean, our industry unfortunately earned a bad reputation, and part of that is on our industry. I'm the first to admit it, and it's an unfortunate thing, but it's a reality. So that counseling is really step one. And depending on the state you live in, you can't do a thing until that counseling's done. So each state's a little bit different in their requirements, but typically you're going to do that up front. In regards to the rest of underwriting, Andy, we look at income and we look at credit history. We don't look at credit score like traditional financing. We look at credit history. So we're a lot less concerned with your score as we are in the last 24 months or potentially 36 months. Have you been on time with your installment and revolving debts, your taxes and your insurance and your association? And if you haven't been, do you have a good reason for not being, whether it's divorce, hospitalization, or death? And if there's a pattern of irresponsibility or incapacity to pay, that's when you're going to run into challenges with underwriting on that side. On the income side, it's really, what are your debt obligations, your mandatory obligations? So again, revolving installment debt, so on and so forth. What are your utility costs and your HOA dues if you have them? And how much money do you have left over? And whether it's one person or multiple people living in the house, it's regionalized across the country, how much residual income you need based on the number of people living in the property, as well as the 4 regions in the country. So that number, varies. Down here in the Southeast, it's just under $600. Other parts of the country, it's a little bit higher. But that's the other aspect of underwriting. And then again, because it's an FHA insured loan, even on the proprietary side, they're gonna hold you to this for the most part. The property has to be eligible. And that's where the condominium conversation comes into play. So typically single family residences, townhomes, and villas. Condominiums, technically, yes, but more often than not, you're going to have real challenges.
Okay. So you mentioned credit score not taken into account at all, or not in a big way?
It's not. If I were to look for traditional financing, I'm going to be tranched based on my credit score, right? So what I'm offered is going to be based on my credit score. It's irrelevant with the reverse mortgage. And here's why. Again, almost all of our focus is going to be the last 24 months. Outside of bankruptcies and foreclosures, it's really the last 24 months that we get focused on. And you could have an awful credit score because of something 4, 5, 6 years ago that's still on your credit report because it's going to hold for 7 years.
Yeah.
So your credit score could be god awful, and that's not going to have zero impact on whether or not you are able to get a reverse mortgage. You might have to explain it and provide a letter of explanation, but it's not going to be a determining factor of whether or not you're approved for the loan, or if you have to have that life expectancy set aside I talked about earlier.
So how does it work? Looks like this should be about it for it. Sorry, one last question. But so I've seen posts in other groups and people ask, like they want to get a mortgage to buy a house, traditional mortgage, but they just retired, wages went away. They have sizable assets, but not a lot of income, maybe Social Security, and they have trouble getting a loan. Is that relaxed or different, I should say, in reverse mortgage? Like, you don't care whether or not they have a job. You know they're likely retired, right? They don't need to repay. So is this the possible answer for someone who's retired, has a lot of assets, but doesn't have a lot of income? Is reverse mortgage a different story? Easier to get, if you will, than traditional mortgage?
It is, and we alluded to that a little bit. We touched on it.
Yeah.
You're not being underwritten for payments of principal, interest,
Right.
taxes, and insurance. You're only being underwritten for taxes and insurance. In addition to that, assets can be treated as income. They can be dissipated. So
Okay.
we can take assets, including the house itself as an asset, and convert that value to an income stream based off life expectancy. So essentially, if you have $500,000 in an account, but you're not taking income out of it, chances are you will not get approved for traditional financing. But for the reverse mortgage, we have $500,000 that's being converted to an income stream. If you have a 10-year life expectancy, well, we've got $50,000 a year of assets now that we can treat as income. So it makes qualifying much more realistic. You go back to, wow, 27% of people at a maximum who got declined for traditional financing in this age group. How many of them fell into that situation? Probably a good amount.
Right. Yeah. Interesting. That's good to know. I never really thought of this as the possible solution for someone with a lot of assets, low income on paper, being able to get a mortgage. So obviously, got to be 62. Okay.
And you think about it, I mean, they can make payments on it just like a traditional mortgage. It does not have to be this non-amortizing loan.
Right.
Somebody like that, it's totally in their control if it is or it isn't. That's where, I don't want to say the reverse mortgage gets demonized, but where people in their heads have put it isn't all the places it could work.
Right. Yeah, that makes sense. Okay. All right. So I already held you here for more than an hour. I appreciate it. Looks like that's it for the questions. Parting words. Where can someone find out more about you, what you do? I know you said this is your website, right? mutualfortlauderdale.com.
Yeah. Well, so, we're in the Facebook group here live. So anybody who's seeing this on Facebook, you're welcome to go to my Facebook profile, my business page. You can go to my website. I have a ton of videos and resources.
You do. Great stuff out there. Yeah.
Yeah. I'm really all about education. I like to consider myself a consultant. I typically do all my work through planners. That's where I get my clients from. So I go to the website. Feel free to reach out to me. I'm incredibly accessible, and business comes when it's appropriate. And I don't really, I would hope people get the sense I'm not here to try to sell anybody anything.
Right.
I will give you these last parting words. This gets used a lot, this word. And I don't love the word because it's not a word people use a lot, but it's an important concept. Wealth is fungible, right? Wealth is fungible. That means the reverse mortgage is a way of spending down the value in your home. If we're spending down the value in our home, it means there's a good chance we're not spending down the value in our other assets.
Right.
And so the reverse mortgage is not necessarily a way to spend down money in a vacuum with no other impact on the rest of our finances. It could very well lead to more efficiencies in the rest of our finances. And that's the concept that I think is starting to really take off a little bit more, Andy. It's just this idea of, if used in coordination and collaboration with the rest of our assets, it can help optimize.
Sure. Right.
And that's really the biggest concept I would love people to understand better.
Yeah. It's another tool. It's another thing at your disposal that could be used when it makes sense, at the right time. So,
Exactly right. Not for everybody by any means, just probably more than it's used for today.
Yeah. Now, so you are in Florida. Are you able to work with people throughout the country, or certain states you're limited to?
I'm in 48 states, essentially. So outside of New York and West Virginia, both very special states, love them both. New York's it's a unique beast in the financial services world. I mean, if people, wherever they're listening in from, I'm happy to have a conversation no matter where you're from. And if I'm not the right person to help you for whatever reason, then I'm happy to try to put you in touch with the person who is.
Great. All right. Just looking here. Thank you very much. People happy here. David Fultz, always a crowd pleaser. Thank you. So informative. Thank you, Josh and Andy.
All right, cool.
Awesome.
Well, that is it. So Josh told me before the call he's usually in bed by 9 Eastern. He's 15 minutes past his bedtime. He's going to turn into a pumpkin soon, so we better let him go. So Josh, seriously, thank you very much. Super informative. Just stick around after I kill the broadcast. So just circle up afterward. But thank you all. Hope you enjoyed.
Thank you, everybody.
Have a good night.
Cheers.